Welcome to another podcast of the Prague Finance Institute. We have the pleasure to host Mrs. Lyn Alden, author of the book Broken Money. Welcome, Lyn, to our podcast. And I thank you very much for participating in our podcast. Your book is excellent. It has many aspects that investors and economists often disregard. So thank you very much.
Happy to be here.
Thank you. We're going to start our subjects by talking about the World Monetary Order. How has the global system evolved since Bretton Woods and the Nixon shock? Are we getting a regime where geopolitical fragmentation replaces the US-centric global order? And what role do sovereign balance sheets and inflation targeting still play? That's the first subject.
Right. So big subject there. I'll start from kind of the system itself. So the Bretton Woods system was based on the idea that the dollar would be the primary ledger for the world. This was after World War II, when the United States was kind of the last economy left standing. It was over 40% of global GDP at the time, and had the biggest industrial base and military and capital markets. And so there were competing visions at the time, but at the Bretton Woods, which is an area, where a hotel was in New Hampshire, where they met, and they decided that the dollar would be pegged to gold, and the world would kind of either peg or hold dollars, and this is how global trade would work on the U.S. dollar ledger. And at the time, it was still legal for Americans to own gold, and the dollar was not redeemable for gold by Americans. It was only redeemable to like foreign official holders, like central banks. It was kind of the last mechanism to maintain some degree of assurance that the dollar is pegged to gold. The problem was that over the next 20 plus years, there was no tether between gold and fractional reserve bank lending and monetized fiscal deficits. And so the number of dollars kept increasing dramatically, both domestically and offshore, while US gold reserves were going down due to gradual redemptions over time. And so by the late 60s, the system was completely broken. It was just like poorly designed from the start, unfortunately, because again, there was nothing that slowed down dollar creation to make it actually backed by gold. And so it basically broke by the 60s. It was mark to market in 1971. And so then the world kind of found itself in this new state of, all these monies in the entire world were unbacked by anything scarce. And so in the 1970s, there was still a significant dollar network effect, known as the Eurodollar system, all the offshore dollars. And the network effect was kind of maintained in a couple ways. One was the dollar was the biggest, most liquid, most saleable money in the world still. So even though it was floundering and inflating away, it was still better than the alternatives in terms of size and acceptability. And number two, there was a significant amount of dollar-denominated debts in the world, which represented inflexible demand for dollars. So even though dollars were printable, there are a lot of entities that needed them. And then the U.S. Made a deal with Saudi Arabia and other countries that basically said, price your oil in dollars globally, only dollars. Store your excess reserves in treasuries, and we'll provide arms deals, military protection, things like that. So they took the existing network effect that was still partially there. They solidified it with certain geopolitical and military deals. And they started kind of a new era where instead of the whole world running on the dollar system, which was implicitly backed by gold, it was just the dollar system itself, dollars and treasuries. That became the actual core of the system, with the caveat that the US was kind of expected that they would maintain some degree of steady monetary policy, right? So they wouldn't increase the dollar by 20% a year in supply, for example. And indeed, since then, the average dollar inflation rate was something like 7% per year on average for the broad money supply. And this is the ledger that the whole world's used. The problem with that system is that the whole world needs dollars. The dollar is used for international contracts for the most part. It is used for global financing. So if an entity in Japan lends to an entity in Brazil, it's often in dollars, even though it's neither of their currencies, for example. So there's all this dollar-denominated debt outstanding. It's on one side of most currency transactions, so something like 90% of foreign exchange activity, the dollar's on 90% of one side of those transactions. So if you're going to trade Korean currency for Canadian currency, usually instead of trading the two directly, you'll trade one for the dollar and then the dollar for the other. It's just instead of having 160 currencies that all have liquid markets with each other, and foreign central banks and foreign entities hold it in reserve to either backstop their currency when needed, or if they have a dollar shortage and they have these dollar liabilities, they can sell reserves, get dollars, and maintain solvency in their liabilities. So that's the system we operate in. The downside is that the America has to supply the world with dollars, and so we've historically done it through the trade deficit, which is that we just keep pouring dollars out into the world because there's all this excess demand for dollars. It overvalues Americans' import power. It makes it less competitive for Americans to manufacture things. So all these dollars flow out into the world every year, and the whole world uses this ledger, which has various issues for the world. It has various issues for the United States, and that's kind of where we find ourselves. 5 decades of kind of a growing imbalance, which is now kind of front and center in the world when we talk about trade, when we talk about reshoring, when we talk about the monetary order. Um, a lot of this is kind of coming back, and it's back in focus when it's historically been in the background.
Okay, we're gonna go back to the dollar later on as a reserve currency. But what I understood, thank you for mentioning the deal between the US and Saudi Arabia in 1974. I guess that what they have done is that they made the dollar backed by oil because they control the price of oil instead of being backed by gold. I mean, this is how we see it. Okay, so what do you think about now? We are talking about the Mar-a-Lago Accords, and they think that it's gonna be a Plaza Accord number two. Um, how we gonna have capital flows flowing freely between countries if this system is about to break or is like cracking? What would be the impact on capital flows if we go into another monetary order?
Well, I think so. It's interesting because the Plaza Accord was more of a cyclical move than a changing monetary order. So the Bretton Woods, so a lot of these accords are named after the area or the hotel that they occur in. So Bretton Woods was named after that area in New Hampshire. The Plaza Accord was named after the Plaza Hotel in 1985. And the Plaza Accord basically kept the existing Eurodollar petrodollar system operating and just revalued it to some extent. So basically, the dollar was getting too strong. It was severely hurting U.S. automakers and things like that. Kind of the same discussions we're having today globally. And so the U.S. kind of convinced its allies to help it realign those currencies. So the dollar fell versus other currencies, particularly the yen appreciated, contributed to the giant bubble that occurred in the late 80s and the early 90s in Japan. But that really just kept the system going. Since the 1970s, the U.S. dollar system has gone through three major cycles of strengthening and weakening. So the dollar was weak in the 70s. It got really strong in the 80s, kind of post Volcker, all the hardening that they did to kind of solidify it and salvage it. Then it had a big bear market after the Plaza Accord. Then it had a big bull market again in the late 90s because of the dot-com bubble and other factors. Lots of capital was just kind of stuffed into U.S. markets. Then in the early 2000s, we entered another dollar bear market, the combination of U.S. recession, U.S. Deficits, military spending, things like that. So that was a bear market. And then in the 2010s, we had another bull market in the dollar. And what a potential Mar-a-Lago Accord could do, similar to the Plaza Accord, is it could kind of deliberately weaken the dollar relative to other major currencies and make it somewhat more competitive for some of the reshoring to occur. But that's still somewhat different than an actual structural change in global financing. So if we just have a weaker dollar, but the dollar maintains by far the largest market share for all the things I previously mentioned, then that's a cyclical move. That kind of buys time for the system, you could say, because ironically the system breaks when the dollar gets too strong, not when it gets too weak, at least within a certain band. Because when it gets too strong, all of those dollar-dominated debts start to they squeeze the rest of the world, and then the rest of the world is forced to sell U.S. assets, often like its reserve assets and other assets, in order to make its liabilities money good, and that kind of results in a liquid broken market. the Fed comes in, provides swap lines or QE and things like that, kind of reliquifies markets, and they were able to keep it going. And so a Mar-a-Lago Accord with a weaker dollar would just buy time. A structural change would represent something like a more multipolar world, which is to say that, for example, right now China makes a lot of loans in the world, and they often do so in dollars. That's the funny thing about these global dollar-denominated debts. They're mostly not owed to U.S. entities. They're owed to entities in Europe. They're owed to entities in Japan. They're owed to entities in China. All these kind of creditor nations around the world. Um, and euro is the second biggest lending market, but especially outside of the euro area, it's much smaller than the US dollar system. And the China system, despite the fact that that money supply is enormous and China's economy is enormous, very little foreign, cross-border financing happens in Chinese currency. And a structural shift would represent a change in that, which is to say, more, say, Asian capital flows and financing would happen in Chinese currency. The euro would probably expand to some extent, and the dollar would remain dominant in its hemisphere. And we'd have a more multipolar system with things like gold or Bitcoin as the neutral, unprintable reserve assets that kind of tie those together. I think we're still somewhat a ways away from that, but we're kind of very slowly directionally heading in that direction based on data over the past few years.
Yeah, but if there is a segmentation, as you say, between the major economic blocks of the world, it means to us that the cost of capital in regions that are net debtors will most probably go up, and the cost of capital in the regions that are net creditors, like China, will most probably go down because you just cut the world in half. What do you think about that conclusion?
So I think it partially depends because right now, for example, China has lower interest rates than the United States. And so if you were an emerging market borrower, and China's your biggest trade partner, and if Chinese entities are, kind of looking to finance with their trade partners, if some of those countries want to shift to the Chinese currency, they could potentially get similar or lower rates if the lenders are Chinese. Because if you're a Chinese lender, you might be doing it for strategic purposes as a state-owned enterprise, for example, basically part of China's indirect sovereign wealth fund. Or if you're a private Chinese entity and you're saying, well, I can get this percent by lending in China, or I can get this higher percent lending abroad in my currency, that cost of capital might not be higher than what those countries can currently get in the United States. In addition, because a lot of these loans are owed to China. If there's ever a major dollar shortage, like let's say a country like Argentina has trouble getting enough dollars to service its dollar-denominated debt, some of that could be owed to China or other entities. They could default on it, and China could say, well, okay, so you don't owe us dollars anymore. We redenominated the contract in yuan, and that's an option. It's kind of a break the glass option, but it's an option that we could see if there's kind of a major realignment. So I think that that's the direction we're headed in, but it's not without frictions. And these things, because the network effects are so big, they often take longer to play out than many market participants expect.
You mentioned just a few moments ago the possibility of having, or maybe the lack of possibility of having a multi-currency world system where countries, they trade between each other in their own currencies. My question here, like the US convinced Saudi Arabia to price the oil in dollar, can we see China pricing its semiconductors in CNY and starting selling being the anchor, let's say, of the semiconductor market in the world and being priced in CNY? What do you think about this move?
So we absolutely could. I mean, right now the leading semiconductors are often made in Taiwan, Korea, elsewhere. China is rapidly improving their semiconductor capability. They are the leader in many other areas. Now, China is now the biggest exporter of cars in the world. They've passed Germany and Japan. This all happened in the past 4 years. Their exports completely hockey sticked in terms of they're rising up the capital goods complexity spectrum. So you went from cheap plastic toys up to full cars. We don't see it in the United States. I'm not sure to what extent you see it in Europe, but for example, I go to Egypt every year. Chinese cars all over the road. Verifies the numbers that I see when looking, at numbers. And so China could absolutely denominate some of its exporting in its own currency. And so right now it's the big, it used to be like 20 years ago, 10 years ago, the United States was the biggest trading partner with the majority of countries in the world. Now China is the biggest trading partner with the majority of countries in the world. There are a rather small percentage of countries, often bordering the US or otherwise in the US orbit, that still have the US as the biggest trading partner, but the vast majority of countries have China as the biggest trade partner. And so they have a decent amount of leverage where they can say, hey, we want to buy this or we want to sell this in our own currency. And for example, it's really hard to have multiple, like tons of currencies be used for international trade because all sorts of imbalances build up. After Russia was sanctioned, for example, they sold some of their military arms to India in Indian currency, for example. And the problem is that Russia would build up all these Indian rupees and not really know what to do with them. The depth of capital markets is not as attractive. There's fewer things they can do with rupees. They can't go then take their rupees and buy, semiconductors from China with those rupees. There's only so much they want from India. They're running a trade surplus with India. And so you really have to be one of the really biggest economic blocks in the world to be able to do this. So China, Eurozone, and the United States are really the only entities currently large enough to have their currencies be kind of globally saleable to some extent. China right now is very underrepresented relative to their size because they have closed capital accounts and other things. But that's certainly a lever that they can pull, and I think they're gradually looking to pull it over time.
Okay, thank you very much for this answer. Let's move to the Bitcoin. I know that from your book, you are a supporter of Bitcoin. Um, I have some questions. First of
Sure.
all, can Bitcoin uh, replace any system that we have now and becomes the world monetary anchor, like gold was, for example, in the 40s or like after Bretton Woods?
I think it can. It still has to be tested more, and to the extent that it does, it'll still take a lot of time because again, it's going up against very large network effects. So when we look at the gold system, one of the challenges, and I talked about this a lot in Broken Money, is that ever since the telegraph was invented and deployed, we've had a really big mismatch between how fast we can send information in the world. It's basically the speed of light anywhere, especially by the early 1900s, as more and more cables were run across oceans and things like that. So global information transfer very quickly, and yet very slow physical transfer of gold or other assets. And the problem is if you can do information transfer, you can make a transaction. You can do an IOU very easily. Um, and settlement, unfortunately, takes a lot more time, and especially the auditing process is substantial for gold. And so you have this really big mismatch. And so what the whole world did is they built all these claims on top of gold and barely ever moved the gold. So all these IOUs would flow around. And even in 1875, there's a book called Money and the Mechanism of Exchange by William Stanley Jevons, famous for the Jevons paradox, but he wrote this book as well and other works. And he pointed out that at that time, so this was like the heart of the international gold standard, that in the United Kingdom, the system is levered 20 to 1. So he's like, if this ever encounters a problem, this is really bad. He's like, on one hand, this is so hyper efficient. All these transactions are occurring and no one's hardly ever moving gold. And yet, it means that the system's very fragile now. And of course, by the time World War I happened, the whole system broke because it was highly levered. So the problem with gold is that there's no quick settlement mechanism other than credit and IOUs built on top of it. So it's mainly good for like longer term, slower moving assets. Many central banks denominate a portion, and they still do today, of their reserves in gold because it's resistant to debasement. It can be self-custodied, so you don't have to worry about a foreign entity freezing your reserves with a stroke of a pen. It's got all these advantages, with the main disadvantage being that it's slow to transfer and audit without a layer of credit built on top. Bitcoin's interesting because it is this network. It's another ledger that, unlike say the U.S. ledger, it's got scarce units, and that's reinforced by node networks around the world. So no entity can unilaterally just print more Bitcoin, and you can send Bitcoin around the world no individual entity can censor the network. And so you have this decentralized unit with its own quick settlement mechanism. So you can send and audit Bitcoin in roughly a half hour, right? So if you send a Bitcoin transactions and wait for an average of 3 blocks to really solidify it, 10 minutes each on average, in about 30 minutes, you can send Bitcoin. Whereas, for example, when Germany repatriated a big chunk of its gold from the United States, that took years. And it actually happened ahead of schedule. They thought it would take even more years, and they were like, "Hey, instead of taking like 7 years, it took 4 or whatever the number was." And it cost millions of dollars to repatriate billions of dollars worth of gold, whereas a Bitcoin transaction, even a large one, could be dollars, individual dollars. Maybe if the network's congested, tens of dollars. You could send $1 billion worth of Bitcoin with that amount. And so you have this kind of global, verifiable, fast network. It's got a leading network effect. So for 16 years in a row, it's the biggest, most liquid, most secure, decentralized cryptocurrency. Um, Second and third place are extremely far behind in that sense. So much like communication protocols like USB or Ethernet or TCP/IP or simple mail transfer protocol, once a communication protocol becomes dominant, it tends to have a very long lifetime. All those communication protocols I just mentioned are 30 to 50 plus years old, depending on the specific one. Bitcoin's 16 and counting. So as long as it remains functional and its kind of properties remain decentralized and secure, I do think it'll continue to grow in market share because it solves both the reserve aspect as well as the ability to transfer that. Now, the downside is that it's still small and volatile. And so central bankers as well as just other entities have career risk. If you're the person at a central bank that says, "Hey, maybe we should buy some Bitcoin and start using this," the problem is if you encounter a bear market and Bitcoin goes down 50%, you're probably out of a job. Whereas if Bitcoin does well, your upside is limited as an individual. So people have career risk that they focus on. So I think it's in the early phases. It's not like, we're going to see central banks just ditching all their treasuries and gold and just going all into Bitcoin. But I think around the margins, we're already seeing some sovereign wealth funds hold it. Some central banks have talked about either settling with Bitcoin stable coins for international trade, a little bit around the margins. And to the extent that the network keeps functioning, I think more and more capital will keep flowing into it, and that more central banks will consider it a potential alternative that over time can grow very large.
The economists that criticize Bitcoin, they have three main points. And the first one is that how the banking system is going to work when you have a limited supply of money. Let's say that Bitcoin replaces, becomes money. So what happens to the fractional reserve banking system? This is one. The second is that governments might decide one day to another to ban it, to make it illegal, like in 1933 when the US made holding of gold illegal. And the third one is what you mentioned is volatility. How come money can be so volatile?
Right. So I guess we'll take those one at a time. Fractional reserve banking doesn't really work on Bitcoin for long periods of time. Generally speaking, fractional reserve banking, um, uh, it breaks frequently. In the fiat system, they quote unquote fix it by printing more units. So the cost of it breaking gets kind of distributed to everyone who uses that currency, both as a savings asset and for denominating their wages in and things like that. There's two types of debt in the world. There's productive debt, which tends to be shorter term, not always, but tends to be shorter term. And this is an example of, let's say you're a business, you've got a very specific business plan in mind. You want to borrow money for the next 3 years to build out that business plan and then use the cash flows to pay off that debt. That's an example of a shorter term, high impact type of lending. Whereas many types of loans in the world are long term permanent debt. The entities are purposely arbitraging the inflationary aspect of fiat currency. So, for example, I often point out that companies like Coca-Cola and Procter and Gamble have been like profitable for like a century straight, and they each have like $40 billion in debt. And the question is, why do they have so much debt? And the answer is because they can. They were able to borrow dollars at like 2% a year for like 10, 20, 30 years and just lock that in. So they're basically shorting fiat currency and they're using it to buy back their own shares or do some capex and things like that. Anything that they can view as a higher ROI than 2%. And that's the type of debt that doesn't really make sense on a hard money system. Similarly, gold has outpaced U.S. house prices over the past, call it 50 years. It'd be generally foolish to borrow money for 30 years denominated in gold to buy a house because your liabilities on average do better than your asset, the house. Um, Things like 30-year mortgages only make sense when the unit devalues more quickly than the asset you're using to purchase it with. But that also has a side effect of inflating home values and people using houses as an investment rather than just utility shelter and things like that, which drives up the cost for people that are lower on the income spectrum that are just looking for the utility aspects of real estate. So my short answer would be that the fractional reserve system really wouldn't be needed, nor would it be possible long term on a Bitcoin standard, and that would in general be a good thing. You still have lending, but you wouldn't really have fractional reserve or like long-term permanent debts that just roll over endlessly. So that's number one. Number two, the banning question is interesting because I mean we've seen India flip-flop on it, they banned it and then like unbanned it. We've seen Nigeria flip-flop on it. China to some extent has flip-flopped on it. Russia's flip-flopped on it. Um, there's a number of countries that have tried it. Generally speaking, it's it's purposely difficult to ban. It's kind of like banning marijuana or other things like that. There's a big gray or black market that can spring up pretty easily because of the nature of the technology itself. In addition, the optics of doing it are bad. It's basically saying you want to have your own money and you don't want to be debased. We're going to ban that. That's a lot of this. A lot of the things in the current system work because they're obfuscated. They're kind of behind the curtain, and when they're kind of put front and center and shown to individuals that you can't own that asset, that tends to not go over well. The comparison to banning gold in America in the 30s is interesting. The pushback I have there is that that was the most centralized political power ever was in the United States, or at least the most centralized since Lincoln, which is to say, FDR won with a supermajority. So he had over 70% of Congress in his party, which means that they could practically do anything. They could override the Supreme Court by stacking the Supreme Court if they had to. They could kind of bypass any sort of objections from the other side of the aisle. And this was during the Great Depression and then eventually during World War II. It was a very kind of unified time in America. And so they're able to get away with something like that. They also, I mean, they put people in camps based on their ethnicity in the United States. They put Japanese people in camps at the time. FDR was also very anti-journalist at the time. So our sacred free speech was kind of temporarily like out the window during that time. So there are a lot of other extreme things that are able to happen in such a centralized environment. But right now, for example, the U.S. is pretty polarized. Um, it's much more. If you're a politician, you get very little from being anti-Bitcoin. Whereas if you're pro-Bitcoin, you get donors, you get support, and so over time, more and more politicians are becoming either Bitcoin neutral or in some cases explicitly pro-Bitcoin. You've seen this from Trump himself. In his first term, he was more explicitly anti-Bitcoin. His Treasury Secretary, Mnuchin, was anti-Bitcoin. And now both Trump and his Treasury Secretary are pro-Bitcoin. And so there's kind of a game theory aspect here, which is that the larger it gets, the more entities are interested in it, the harder it is to ban. Now, Europe's still, I think, more of a risk in that. Just the populace and the politicians on average there. Depends on the spot, of course, but there's more risk there. So there's certainly individual country risk in terms of temporarily banning Bitcoin or adding frictions to Bitcoiners. But globally, that's pretty hard to enforce at the current time. And then even if a big country does, that opens up opportunities for other countries to say, well, we're not banning it. So if you're El Salvador or Singapore or whatever, you can be like, well, come here then. If you got a lot of Bitcoin and you want to continue operating yourself or your company, come here. So it's kind of not great game theory to try to ban it. The third point about volatility. So Bitcoin started at zero. And if it's going to become a $10 trillion asset or a $50 trillion asset, it needs upward volatility to reach that. And with upward volatility comes leverage and euphoria, which means periods of downward volatility. So, I describe Bitcoin as an emerging store of value, which is to say that it's going through its bootstrapping phase. It's being tested and explored by global market participants. And so that volatility is a necessary part. If you were to look at like a venture company, they don't really trade on public markets. But if they did, they'd be very volatile. Because if you're a startup company, the smallest bit of good news or bad news can have major implications for the future value of that company. And the same thing is true for like a startup money, which is basically what Bitcoin has been. Um, as it's gotten larger, the volatility has gradually reduced. It's still pretty high, but as it becomes, right now it's still under a $2 trillion market cap. Briefly, it was over 2 trillion at its peak. If it becomes a 5 trillion, 10 trillion and plus market cap asset that's more widely held, it's much harder for any individual entity to move the price. It's much more liquid, and it becomes more politically solidified. So it was easier to ban Bitcoin when it was a $10 billion asset than when it's a 1.5 or $2 trillion asset, like I previously discussed. And so when you start taking off the tail risks, some of that volatility can go down. In addition, I mean, because it's been largely pushed out of the financial system, banks have been blocked from being able to hold it. Uh, we have this kind of industry pop up where like exchanges in the Bahamas, run by kids, are like the where people trade with it, and then they do fraud and blow up, which adds to the volatility. So as Bitcoin becomes larger and more integrated with serious players involved, that volatility should, and so far is, reducing over time.
Before to move to the other subject, and thank you again for your explanation, I cannot imagine how governments, and especially powerful countries like the US or the Eurozone or Japan, are going to let go the most important public good that is under their control, which is money. And with money, they can control societies. Governments work. Politics, they evolve around money that the governments control. So if they lose this control over money, I mean, why we should have governments?
Well, so I mean, governments existed back, for example, on the gold standard. Generally, whatever entity becomes kind of monopoly power becomes kind of the government. Even in ungoverned areas, you generally get warlords and things like that. There's the power kind of coalesces one way or another, and of course that's a whole rabbit hole of discussion around optimal politics and things like that. But basically, power finds ways to concentrate and build up from there. So that can take various forms. Um, One thing we can look at is in emerging markets, when they eventually have currency failures because there's not a lot of demand for their currency and they print too much of it. Generally speaking, the dollar comes in. So people start turning toward the dollar, and
Mhm.
sometimes governments do try to make it illegal and pressure on it. It's very hard to enforce when they don't have a better alternative, and people by the millions are turning to alternatives. Um, and so we could see a similar thing in major countries. It just takes a much bigger shock in a much longer period of time. So the United States and China have a lot more resources to defend their currencies, um, even as these grow. So partly it happens because the world can go around them. If one country decides to be all closed off, again, the rest of the world can do game theory and say, well, we're not closed, so get out of that place and come to us. In addition, inside of it, various large entities can lobby politicians, and different political systems work differently to kind of have protection for themselves. And you can still have like there will still be the United States will still be trying to surveil Bitcoin holders to tax them. They will still probably be trying to place taxations on anytime Bitcoin is spent for quite a while to make it more of like a gold-like asset. Whereas in certain countries like El Salvador, you can move it around kind of tax-free, and certain other countries. So you can use it for more spending more easily. So there still are various frictions that powerful countries can add to it. But much like how the dollar kind of inserts itself into failing emerging market currency areas, over time, should we get destabilization in some of these more major currencies, Bitcoin is there as kind of like this harder, just as fast currency that's moving around the world. And governments have a lot of power to defend their currencies, but not infinite power, especially if the populace kind of turns against them, views their currency as unstable and failing. But for these major currency blocks, I think that's a long way away.
Okay, thank you again for your explanation. I want to move a bit to the US dollar as a reserve currency. A lot of
Sure.
people or economists are saying in the market that, we can have the CNY as a reserve currency, we can have the ruble, the Brazil real, whatever. But there are, in my opinion, there are two main conditions for a country to become reserve currency, and there is a third one, which is a result of the first two. Well, the first one is the rule of law. I mean, you cannot have a reserve currency that does not respect private ownership or capital flows flowing inside, in and out of this country. And the second one, you mentioned it is deep financial markets. Uh, what do you think the based on these two conditions are the prospects for other currencies to compete with the US dollar?
So I think they still have a long way to go. But I think that they directionally, very gradually, are heading in that direction. And generally speaking, uh, it partially determines how good the U.S. is performing because we're not static either. It could be argued that the U.S.'s rule of law has at least mildly deteriorated. For example, by freezing Russian reserves, that has encouraged many other countries to shift course. And then in the current administration, there's pretty hard negotiating tactics we're seeing and kind of unilateral top-down decision making, which spooks global markets. And so on one hand, kind of the esteemed U.S. rule of law over decades is to some extent unraveling, I would say, or at least fraying around the margins. Europe, uh, they've historically had good rule of law. It differs somewhat from the U.S. One of the issues there is the fractured capital markets. So even though there's a shared currency across the Eurozone, capital markets are still segmented, and that hurts liquidity and things like that. And so that's been a roadblock. China, they've had issues on both sides. So on one hand, their liquid bond market and stock market, despite being fairly large because China is so big, they're nowhere near the size of the U.S. They've got capital flow restrictions, and then they also have rule of law challenges, which is basically that if the president doesn't like a certain industry, they can just crush it. If they decide we want to promote real estate can go up. If they want to suppress real estate, they can send it down. And there are certain pain points, like when they run into the populace getting angry at them, they tend to pivot. So it's not as though the top-down power has full control, but they can certainly push things around for many years at a time. And historically, the Chinese stock market has not been well performing because they don't prioritize it like the United States has. They've been prioritizing their bond market more recently, which solidifies it to some extent. I think they are trying to gradually establish trust in their bond market for starters. And I think to some extent they learned their lesson from their stock market crackdown in 2021, because they've had kind of capital outflows for the first time in a long period of time, basically outflows of foreign direct investment. And I think that's a pain point that they ran into. So I think that over time, China can gradually open their capital markets and basically have build a track record of respecting foreign capital more. But that takes time. That's a long trust thing that happens over time. And so I think that it starts with their trading partners. They have a lot of leverage because of they have a lot of their industrial base is very hard to replicate elsewhere. Um, their energy production, supports their industrial base. They have big clusters of know-how, manufacturing expertise. That's a powerful network effect. And they can use that along with their gradually improving, respect for capital, assuming they don't mess it up. So I think that there's a directional shift toward a multipolar world, but there's still a lot of work to do. And when you get to outside of those three big currencies, I don't think there's much prospect. I don't think there's much prospect for example, for Brazilian currency to be widely held outside of Brazil, um, Indian currency, at least the next 10 years, to be widely held outside of India. And it's kind of a long tail after that. So I think it really comes down to the biggest three currencies at the current time, as well as these neutral reserve assets like gold and Bitcoin.
To continue to talk about this important subject, and thank you again for your answers. And you alluded kind of to that aspect of a reserve currency, which is called the Triffin dilemma. I mean, a reserve currency, the country itself has to export this currency and have a trade balance deficit. Do you see China and the Eurozone getting there in order to become a reserve currency to flood the market with euros and CNY through trade balance deficits?
The short answer is not really, which is why I don't think there's any ever again going to be a country that issues the primary reserve currency. The imbalances are just too big. The United States was kind of an exception after World War II because we had literally over 40% of global GDP and kind of the only intact manufacturing base and functioning capital market. That's a very unique situation. Um, and over time, the U.S. has fallen to 25% of global GDP measured nominally. That includes the overvalued dollar and about 15% of purchasing power, parity GDP, and only like 4% of the global population. So it's hard to have that that's large but shrinking percentage of kind of global economic activity and yet be the primary ledger for the entire world. Those imbalances get very big relative to the US economy. On the other hand, if you had regional currencies, so if Europe primarily, like if their currency primarily serves Europe and maybe their biggest trade partners around them, so North Africa and certain other areas, that means that the imbalances, the amount of euros that they have to export are not very significant as a percentage of the economy. If the U.S. kind of dollar network shrinks to our part of the hemisphere, that reduces those major imbalances compared to the size of the U.S. economy. And if China expands theirs to some extent to be more used by their trading partners, but again, not used by like the whole world, like you wouldn't see Mexico using Chinese currency as its like main reserve asset, for example, then again, it reduces those imbalances. And then on top of that, if there's more of a shift toward neutral reserve assets like gold or Bitcoin, then that can eliminate those imbalances entirely. But that's still farther away. So I think that the first step is over time, basically out of necessity and dollar shortages and problems and things like that, there's just a slightly more multipolar world which at least spreads those imbalances out to some extent. And then, the long-term potential solution is to increase neutral reserve assets as a percentage.
Okay. Thank you again. And you mentioned something very interesting about inefficient debt and efficient debt. Now we have a situation where we have in the world economy maybe like 300% of world GDP in debt, and we have governments that have a lot of debt. One of them is the US. How do you think governments, let's talk about governments paying back their debt? How are they going to do that? Is it inflation? Is it default? Is it like, coercion?
So I think mostly inflation and financial repression. Um,
Okay.
Countries very rarely default at the sovereign level in their own currency. It's extraordinarily rare.
True.
Um, Emerging market countries often default when they owe foreign currency because they literally, much like a company, they often have no choice. They literally they run into the inability to meet those debts. Whereas countries with their own major currency, they often just print when they need to. So it's a type of default. It just happens via purchasing power rather than nominally. And we've partially already seen this. I mean, in 2019, there was $18 trillion worth of negative yielding bonds in the world, mostly Europe and Japan bonds. But even in the US, we had very low yields. And anybody holding basically any of these bonds over the past 5, 6 years got absolutely destroyed in terms of purchasing power and compared to virtually any other financial asset you could own. You should have owned any other major stock index, gold, Bitcoin, real estate, fine art, almost anything other than bonds and just raw currency. Some of the worst things you could have. And that's partially because inflation partially offset a lot of the debt increase and the money printing we've seen in recent years. And we can certainly have more rounds of that. Or if it's not that extreme, you can still have gradual, printing it away over time. When we look at, for example, the United States in the 1980s, generally speaking, the yields you got on bonds, um, a lot of people compare it to the CPI, the inflation, price inflation, but a better metric is to compare it to money supply growth. And so in the 1980s, bond yields were often higher than money supply growth. So you actually got a real return if you took the risk to lend to the US government. Whereas for years now, bond yields are well below money supply growth. So if you're holding bonds unlevered, you're gradually getting inflated away. Your share of the system is shrinking, while people that own scarcer assets, and then if anything, if they're shorting the currency, they're borrowing for the sake because they can. If you're a big financial institution or wealthy individual, you can borrow, until recently, you could borrow money at pretty low rates and use it to buy scarcer assets. You could finance scarce things. You could buy cash flow producing businesses, and you're shorting the currency, and all the bond holders and the currency holders are the ones paying for it. So I think going forward, we're going to continue to see sovereign bonds and just most bonds in general not do very well on a purchasing power basis. Yeah, maybe not as bad as the past 5, 6 years, but over time, I think they're continue to not do very well, and they could have further bursts of negativity. And to the extent that it becomes a problem, you could see some pockets of financial repression. So you could have sovereigns mandating their banks to hold more treasuries, for example. We've already seen some of this. Um, you you could have governments tell pensions to hold more of it. It's harder to tell individuals to, but they can try. I mean, retirement accounts and kind of locked in pools of capital potentially could. Um, and so that's the kind of the mechanisms that they have. And of course, those become increasingly unpopular. Uh, Voters and citizens get angry over time, especially if, again, in the Great Depression and World War II in America, there was this big feeling of unity. People were willing to sacrifice because they all felt like we're in this together. We support what's going on, at least on average. And so they're able to kind of take losses. If there's no kind of great reason for it, if they view their political leaders as incompetent, if they're suffering pain, but they don't really feel like their next generations, that their kids are going to be better off than they are, which is kind of the first time in modern history where that's happening now, where like life expectancy is not increasing in the U.S. anymore. In many places, the U.S. and Europe, the next generation is not expected to be wealthier than the prior generation. Um, then the populace has a lot lower tolerance for financial repression. And so it's a lot more turbulent. You get rising populism, you get rising political polarization, and to some extent, it can become dangerous because sometimes the solution people will turn to is just as bad or worse than the current system, and the pendulum can swift very far. We've seen this a lot in history, so it's kind of a narrow path, I think, in the next couple decades, and hopefully it goes smoothly, but we'll see.
That brings me to the last subject, actually, and it's very good that you have mentioned it, that there is no other way than financial repression and a bit or like a sticky inflation. But these policies of negative bond yields have led to a massive rise in asset inflation or massive asset inflation, which led, by the way, to inequality. How the societies, they're gonna accept a third round or a fourth round or a fifth round of yield curve controls, negative yields on bonds, inflation. I mean, the inequality levels are already at very, very high levels.
Well, I think that it'll depend on the jurisdiction. On average, the U.S. has very high wealth concentration. Different countries have different levels of it. Like Japan's is on the lower end, for example. I think the rate of it will probably be slower now because I think we're in a period of structurally higher rates and potentially a difference between government rates and private sector rates. So we've already seen in the U.S., for example, we have an unusually wide spread between mortgage-backed securities and treasuries. So mortgage rates are higher than average compared to treasuries than they have been. So if you're the government, you're still borrowing at pretty low rates, not super low, but semi-low. Whereas if you're a home buyer, you have very high rates to pay. And I think that spread's probably going to stay wide for a while. And for example, when you look at the Fed's plan, they plan to, they're already slowing down their treasury quantitative tightening. They're eventually going to stop it and probably go back to increasing their treasury holdings while continuing to sell off their mortgage-backed securities, which should keep that spread fairly high. So they're basically saying, if you're the private sector, we're going to make borrowing costs high for you. And for the government sector, we're going to do financial repression and keep those yields on the lower end.
How
And
can they do
that
that on the corporate side? Sorry to interrupt you. How can they do that on the corporate side? You talked about the mortgages.
So basically, by having short-term rates still somewhat elevated,
Okay.
and the Fed not buying corporate bonds, or other central banks not buying corporate bonds, then those can still be somewhat elevated. Now, if you're a major blue chip company, you'll probably still have pretty low borrowing costs. So it's not like every entity is the same, but on average, I think the spread between what the government borrows at and what small, medium businesses and individuals borrow at will be pretty wide. And even corporations, if you're Procter and Gamble and you could borrow at 2%, um, and buy back your own stock, it was a no-brainer to do it. If you can borrow at 5%, that's a more mixed trade. It's not guaranteed that your stock's going to do better than 5% over, say, a 5, 10 year period. And so that's a riskier trade to make. And so I think you'll see a little bit less financialization in that sense. But I do still think wealth concentration is going to be an issue for a long time. And I also think that in this higher rate environment, stocks, right over the past decade, U.S. stocks were the major performers. I think the next 5, 10 years don't look as good for U.S. stocks, especially on an inflation-adjusted basis. Um, Other pockets of the world will be different. It depends on the market. Like, I'm fairly bullish on Brazil to some extent, and certain other pockets of the world. But in general, I think we'll have kind of weaker asset price returns, especially relative to inflation. And so it'll be that era of kind of financial repression. Similar things happened in the 1940s, which is, stocks didn't do great. Um, Real estate kind of had a one-time revaluation based on money printing and then kind of was stable for a while. And I think we've kind of seen that. We've seen a big jump in US house prices and it's flat for a while. Similar things in Europe. I don't follow every market the same. I follow global markets, but there's different markets that I follow, certain aspects of their markets more than others. But in general, I think we're in a kind of a global, at least among developed countries, a global period of financial oppression. And I think the rising populism is still an issue. I've been warning about it before, and I think it still has worse to go before it, reaches some sort of crescendo, both in the United States, Europe, and potentially elsewhere.
Do you see any probability or high probability of having social unrest in our world, in the Western world?
I do. I think, and it could take a couple forms. I mean, in the United States, a catalyst is that by the mid 2030s, Social Security trust fund runs out. So politicians are going to have pretty hard decisions to make at that point. They could just print more money and keep it going, but that gets pretty explicit at that point. They could try to cut benefits, but that's extremely unpopular. We could see similar things in Europe with European retirement systems. The further this goes, the more lopsided these get in terms of how many retirees there are compared to how many workers are supporting those retirees. We could see AI related disruptions
Mhm.
as well. Um, if there's another round of energy disruption. Right now energy prices are cheap because global economy is slowing down and they're pretty well supplied. But years in the future, we could have another round of like energy shortages and high energy prices that can cause unrest. And generally speaking, I mean, if people view things as a one-time phenomenon, and they can often put up with it. But if it's happening to them for like the third, fourth time, they start to see it as systemic, and that the system itself is broken rather than a one-time thing. And then they start making changes that they wouldn't have made based on that one-time thing. And that could be unrest, that could be how they invest, that could be how they vote, that could be all sorts of things. And so I do think that as we enter the late 2020s and potentially the 2030s, um, these things will probably hit some sort of crescendos, um, where kicking the can down the road runs out of road and certain really hard decisions have to be made. And people have to the problem is that people will all disagree on what caused it, what were the root causes. And some of the root causes are really wonky. Like we just talked about the structure of the US dollar system. Most people don't wake up and think, if only we didn't structure our trading system like this, it'd be better. If only, we didn't have to supply so many dollars to the world to use that as a reserve currency. That's not what people think of. They blame their politicians, they blame corporations, they blame whatever's kind of closer that they can point out to. Often because it's partially true. And of course, people on different sides of a political spectrum will blame certain aspects, and that's how you get unrest or polarization, and sometimes pretty extreme outcomes.
Thank you very, very much. We covered all the subjects that we wanted to cover with you. Lyn Alden, from author of Broken Money. Thank you, and we finish our podcast.